What is an ETF? It is probably the most powerful way to make money on the stock market today. And let's admit it, some of these lessons were exactly what we needed way back in school. But unfortunately, most of the schools don't teach these things. So let's go on and learn exactly what they are. ETF simply stands for Exchange Traded Fund, which is a financial product that is traded on a stock exchange, just like individual stocks. Talking about individual stocks, you may probably have ever thought of owning or buying some shares like Apple, Amazon, Google, and the others. But the thing with individual stocks is that owning a lot of them, because of course, if you want to make much money, you have to own a variety of them. So owning a lot of them comes with a whole lot of problems. One, it's very expensive to own multiple stocks from some of the very big companies. And secondly, it becomes very difficult to manage because you have a whole lot of them from diverse backgrounds making up your portfolio, so it becomes difficult to manage them. And that is exactly where ETFs come in, because ETF presents you a cluster of all these different shares which are pulled together and presented to you as a unit. So in simpler terms, you could say ETF is a collection of different financial products. It could be bonds, commodities, it could be shares that are put in a single basket and delivered right to your doorstep for you to enjoy. So let's try to understand it from the name, Exchange Traded Fund. So the fund here simply implies that it is an investment fund. So when you invest in an ETF or when you buy an ETF, you have added your money to a pooled fund or huge sums of money generated by different investors, which is then used by a professional team to invest in a diversified portfolio of assets like shares, bonds, commodities, and other securities. And the exchange traded part of the name simply means that ETFs are bought and sold on a stock exchange like the New York Stock Exchange or the London Stock Exchange, just like individual stocks. So in the form of a summary, we could say ETF is an investment scheme that allows investors to pool money together, and we are talking about several billions of dollars, which is then invested in a diversified portfolio of assets that could be traded on the stock exchange. So for us to properly understand exactly how ETFs are generated or created and how they work to make money, let's use a very simple or a basic illustration against a real world illustration. So let's assume you are definitely going to get rich with ETFs, but before you do that, you just want to please your boss for the last time, so you have decided to buy his daughter a very good present for her birthday, and you know very well that the daughter likes to play with toys. Now the problem here is you have no idea the exact toy that is going to make the daughter happy. You have options, either to show up with one or a single toy which she may or may not like, or instead just get a basket and fill it up with a lot of different toys. And even here, it is not guaranteed that she's going to like the toys. She may end up liking all the toys or some of them, but the probability of the daughter liking at least just one toy has been increased by 1,000, and I would explain this probability later. So in this basic example, the basket is the ETF, and what makes up the ETF is the 100 or even the 1,000 different toys that you stuck in there. And the catch here is that you got the whole basket of these different toys for the price of just one toy if you bought it outside the ETF arrangement. Now let's look at a real life example, but flowing from the basket of toys example, let's look at a real ETF, which is the SPY or the S&P 500. This ETF tracks the performance of the top 500 or the 500 largest publicly traded companies in the US. And remember, we are saying here that it tracks the performance of these top 500 companies because we are going to explain it later. So the S&P 500 is made up of toys or contains stocks like Apple, Amazon, Microsoft, Tesla, and some other very big companies. So all 500 of them are all put in this one basket, which is the S&P 500. You may remember we said ETFs tracks the performance of some companies that are publicly traded on the stock exchange, right? So now understand ETFs as a mere representation of an already established sector of the financial market. When you buy a share of an ETF, for instance, the S&P 500, as we used in our real life example, we said the S&P contains some companies like Amazon, Tesla, and Microsoft. So when you buy a share or a part of that ETF, you don't actually own shares of the underlying assets of that ETF, which means that you don't actually own shares of Amazon or Tesla, because this is what happens. The creators of the ETF actually go out there and buy the specific shares of these companies, several billions of them, and put them all in a single basket. So when you and I buy an ETF, we rather buy a small piece of this basket. So the basket itself has also become an asset on its own. So we rather own a small piece of the basket, which is the ETF itself, and not the underlying assets that make up the ETF. So how then do we make make money if we don't own the actual shares of the companies that make up the ETF. So we said the ETF, like the S&P 500, tracks the performance of all these 500 companies that make up that basket. So what it simply means is when the value of those companies go up, because it tracks the performance of those companies, the value of our share of that ETF or the basket also goes up. And remind you, because we can trade our ETF on a stock exchange, just like the individual stocks that make up the basket, we can offer to sell our shares to other people or even buy more shares from other people. And that's exactly how you make money with ETFs. When we talk about investing on the stock market, a very key strategy to adopt is diversification, which simply means you subject your portfolio to different shares from different classes, because that is when you can be very confident that even if not all, some of your shares are going to perform well for you to increase your return on investment. And this is primarily the whole objective of the ETF arrangement, because when you invest in an ETF, it exposes you, the investor, to a wide range of assets or companies in a single investment, and it spreads your investment risk across all these companies rather than relying on the performance of a single company. Remember our basic example that we made about the toys in a basket. So in putting different toys in a single basket, you increase the probability of she liking at least one of them by 1,000. So now let's assume we own the S&P 500 and we have 500 different companies, very big companies, in the same basket of the S&P 500. So let's assume right after investing in that ETF, most of the companies like Amazon, Tesla, and Apple don't do well for that particular financial year. But we have one company like Microsoft which performs very well in that year. So the performance of Microsoft in this instance cushions you from all these losses you would have incurred if you owned these particular stocks individually. So the performance of Microsoft affects the entire basket so that you still make money even though most of the other companies did not perform well. So this is what we meant by you've increased the probability of your boss's daughter liking at least one of those toys in the basket. So owning an ETF, you increased your chances of still making money on the stock market even if most of the companies in the ETF don't perform. As at the time of making this video, these 5 ETFs are some of the very popular ETFs on the market according to their assets under management. So we have the SPY, one of the S&P 500 ETFs with an AUM over $400 billion. Then we have the IVV, which is another type of S&P 500 with an AUM over $300 billion. We have the VTI with an AUM over $300 billion, and the VOO, or the Vanguard S&P 500 ETF. And this particularly is my favorite for some reasons, with an AUM over $330 billion. And then the Invesco Triple Q Trust, which has an AUM over $200 billion. So that is it on ETFs today. This list is not an exhaustive list. It is just an example to show you some of the options out there and at least some of the criteria to look out for when you are choosing the best ETFs for yourself. Please don't forget to like and subscribe to this channel for more videos like this. My name is Paddy and I'll see you in the next video.